What if every financial crash you've ever seen was met with a secret playbook, one that only the insiders get to read? Picture this: a marble-walled boardroom late at night. The city outside is silent, but inside, the world's most powerful bankers are huddled over thick folders and glowing screens. Coffee is steaming, phones are buzzing with coded messages. Somewhere, a red light blinks, another market is breaking. From the Great Depression all the way to 2008, banks and central bankers have been quietly rehearsing for disaster. They run secret drills, they swap confidential memos, and they prepare moves that the public never ever sees. While the headlines are screaming panic and chaos, the insiders are already calmly flipping to the next page of their playbook. Imagine a sudden run on gold in 1931, or a midnight emergency call to JP Morgan back in 1907, or a modern host stress test that triggers $1 trillion bailout before you even had your breakfast. What do the world's top bankers know that you and I don't? How do they not only survive, but sometimes even profit while the public panics? In this video, we're going to uncover the hidden drills, the secret signals, and the playbook that has shaped every major crisis. But to understand it, we need to go back in time. Let's step into the 19th century. The air in New York is thick with coal smoke and anxiety. Crowds are gathering outside banks, clutching their paper notes and gold coins. A single rumor, maybe whispered in a saloon or printed in a morning paper, is all it takes to spark a stampede. This was an age before safety nets. There was no deposit insurance, there was no central bank, there was just trust and fear. During the Panic of 1837, banks failed, businesses collapsed, and families lost absolutely everything. Men in top hats and frock coats rushed to the vaults, desperately hoping to withdraw their life savings before the doors slammed shut for good. Gold vanished overnight. The city's heartbeat practically slowed to a stop. Now, let's fast forward to 1907. A failed speculation in copper triggers a massive run on the Knickerbocker Trust. The lines of panicked depositors snaked around entire city blocks. Bankers met in smoke-filled rooms, desperate to stop the contagion from spreading. This is when J.P. Morgan, the financial titan of the era, famously locked his peers in his library. He refused to let them leave until a rescue plan was forged. This was a pivotal moment. These early panics taught a brutal but essential lesson. Survival depends on speed, secrecy, and coordination. The very first playbook was written in real time, improvised right in the heat of the crisis. Then came the Great Depression. In 1931, a global run on gold drained the world's reserves. Banks collapsed from Chicago all the way to Berlin. Politicians and bankers were scrambling for answers. The Federal Reserve, which had been created in 1913 to be the lender of last resort, was put to its ultimate test. Suddenly, terms like liquidity, bank run, and contagion became part of our everyday financial vocabulary. Behind the scenes, secret meetings, coded telegrams, and midnight deals became the norm. How did a handful of men in a smoke-filled room manage to stop a national panic? Why did that first playbook have to be written in real time under such immense pressure? The answer lies in the evolution of money itself. As money went from physical gold to paper and then to digital bits on a screen, the playbook had to evolve with it, and it had to evolve fast. The lessons learned in those early crises laid the foundation for the complex, high-tech financial rescue operations we see today. From manual interventions to automated circuit breakers, the goal remains the same: control the panic, manage the chaos, and protect the system at all costs. Step into the late 20th century. The world's money is no longer backed by gold, but by faith and by the promise that someone, somewhere, has a plan. It's 1971. The Nixon shock completely severs the link between the US dollar and gold. Suddenly, currencies are floating freely, and markets are moving at the speed of light. Picture Wall Street's trading floors buzzing with a new, chaotic energy. Computers hum in the background, but the real noise is the traders, shouting over the din, chasing profits in a world where risk is everywhere, and so is reward. But as the markets got faster, the playbook for managing them had to change. It was no longer just about stopping people from lining up to pull their money out of a bank. Now, it was about something far bigger and more abstract. Systemic risk. The stakes were getting higher because the banks were getting bigger. A single failure could trigger a domino effect, bringing down the entire global financial system. Then came the first big test, October 19th, 1987, Black Monday. In a single brutal day, markets around the world crash. Panic is in the air. But behind the scenes, the U.S. Federal Reserve steps in, opening the floodgates and flooding the system with liquidity to keep it from seizing up. A new phrase is quietly added to the playbook: whatever it takes. Fast forward about a decade. Long-term capital management, a hedge fund run by Nobel Prize-winning economists, the smartest guys in the room, is on the verge of a catastrophic collapse. Its failure threatens to take down major banks with it. The Fed calls an emergency, secret meeting in New York. The most powerful bankers in the world are summoned. and they hammer out a multi-billion-dollar private rescue before dawn breaks. The lesson learned that night was chilling but clear. Some institutions had become too big to fail. And then came the ultimate test of that idea. 2008. The world watches, glued to the news, as Lehman Brothers, a 158-year-old investment bank, files for bankruptcy. The failure is a gut punch to the global system. Panic spreads like a virus. Credit freezes solid. People wonder if this is the end. But behind the scenes, the playbook is already in motion, updated for a new, terrifying reality. Central bankers and finance ministers hold frantic midnight conference calls across continents. They coordinate massive, unprecedented bailouts. They run stress tests on the remaining banks to see who might fall next. Secret lending windows at the Fed are opened. They inject trillions of dollars, euros and yen, into the system, swapping currencies to make sure money can flow where it's needed most. All the while, they have to put on a calm face, reassuring the public that everything is under control. It's a delicate choreography. If you move too soon, you create the very panic you're trying to prevent. But if you move too late, the contagion spreads and the entire system burns down. How do you save the world's economy without letting everyone know just how close it is to the edge? But just as they were getting a handle on that crisis, the digital age brought new threats. The trading floors went silent, replaced by servers humming in dark, cold rooms. Now, it's 2010. There are no shouting traders, no panicked crowds on the street. Instead, a single trading algorithm misfires. In just 36 minutes, the flash crash vaporizes nearly $1 trillion of market value, before mysteriously bouncing back. The crash was caused and corrected by pure code, moving faster than any human could possibly react. Regulators and bankers had a terrifying realization. The next financial apocalypse might not start with a rumor or a bad investment, but with a single flawed line of code. So the playbook had to evolve again. Circuit breakers were installed across markets, automatic kill switches that halt all trading if prices fall too fast, giving humans a moment to breathe and figure out what's going on. Banks were now forced to write living wills, detailed step-by-step plans for how they would be safely dismantled if they failed, a direct attempt to end the too-big-to-fail problem once and for all. And central banks started running entirely new kinds of drills. They began staging complex cyber attack simulations, wargaming scenarios where hackers take down critical payment networks or freeze the digital plumbing of finance. The battle to save the system moved from the trading floor to the world of cybersecurity. The playbook is a living document, constantly being rewritten to fight the last war while trying to predict the next one. The year is 2020. COVID-19 hits. Markets plunge into freefall. Within days, the Federal Reserve acts. They slash interest rates to zero, launch unlimited quantitative easing, and open secret swap lines with central banks around the globe. Trillions of dollars flood the system almost overnight. This isn't just a response, it's a playbook, one written and rehearsed in secret. Meanwhile, a new financial architecture is rising. Central bank digital currencies, or CBDCs. China is already piloting its digital yuan. The European Central Bank and the Fed are deep in study. This promises a future where money itself is programmable. But it also raises a terrifying new question. What if the next crash isn't triggered by bad loans, but by a line of code? A cyber attack, a rogue algorithm, or a digital run on the banks that moves at the speed of light. Right now, in war rooms and boardrooms hidden from public view, bankers and regulators are rehearsing for these exact scenarios. They run drills the public never sees. They test how fast they can freeze accounts, reroute payments, or inject digital liquidity before panic spreads like a virus through the network. They're preparing for a crisis that moves faster than human thought. But the big question remains, is this playbook really about saving the system, or is it about saving themselves? Picture two worlds happening at the same time in the same city. In one world, a boardroom glows with the light of monitors late into the night. Bankers and regulators huddle over screens, deciphering coded memos, running stress tests, and preparing for the next shock. They know the signals. They wrote the playbook. In the other world, a family sits in their living room watching the news flicker across the TV. Markets are crashing. Jobs are at risk. Their savings, their home, their future, all suddenly hang in the balance. They don't have the playbook. They don't even know it exists. When that playbook is activated, insiders always move first. Banks get massive emergency loans, often in secret. Key markets are stabilized with trillions in support. But on Main Street, the pain is real and it is deep. Foreclosures, layoffs, and retirement dreams vanishing into thin air. Why does it seem like a select few always escape the crash, while everyone else is left to pay the price? It's because the playbook is built to save the system, not the individual. Bailouts save banks, but not homeowners. Secret memos circulate long before the headlines break. By the time the public understands what's happening, the insiders have already made their moves and protected their assets. So, what is the real cost of a system built on secrecy? And who really wins when the playbook is opened? This hidden banking playbook is both a shield and a sword. It protects the financial system from total collapse, but it often does so by keeping the public in the dark and leaving them vulnerable. Every crisis, every bailout, every midnight meeting is a stark reminder that the rules of the game are written before you even know the game has begun. History shows this cycle repeats with chilling regularity. Boom, bust, rescue, repeat. From the bank runs of the Great Depression to the flash crashes of the digital age, the playbook adapts. But the fundamental risks never truly disappear. They just change form. The next crisis might not look like the last one, but its impact could be even greater, spreading faster and wider than ever before. So what can you do? How can you learn to read the signals and protect yourself before the next crash? The answer isn't just in watching the news, it's in understanding the patterns, the drills, and the hidden history that shapes every move the financial elites make. It's about recognizing the warning signs before the panic sets in. Will you be ready when the next playbook is opened? Subscribe for more cinematic economic history, and we'll show you how to spot the next crisis before it hits.